Good evening and welcome to Direct from the Desk. My name's James Gerrish. I just wanted to give you a quick rundown in terms of the COVID-19 situation before we start trade tomorrow for a new week. No doubt it's going to be a volatile one, as the last few weeks have been. Just taking a step back for a moment, I think the situation we find ourselves in is quite extraordinary. It's an unprecedented situation. We've got over 300,000 confirmed cases of the virus globally. There's more than 13,000 people who have died from the virus. So from a humanitarian perspective, this is an incredibly significant event on a global scale, and it's causing a huge amount of global disruption, the likes we've never seen before. So, from a market's perspective, I think you step back and you've got to look at a comparison being the nearest comparison being the GFC. The GFC is falling into sort of insignificance. I was trading through the GFC and I didn't think it was as aggressive as what we've seen play out in terms of the COVID-19 outbreak. Markets have been simply moving in an unbelievably volatile way. It speaks to the uncertainties that's developing around the COVID-19 outbreak, the concern that central banks and governments around the world will not be able to do enough to curtail the spread, and the concern from the general population. So if you think about the GFC was a problem, an issue made on Wall Street. This is an issue that is confronting Main Street. So I think from a market's perspective, there's a couple of things that we need to be taking out here. On the screen in front of you is just a quick rundown, some interesting assets, prices, movement since the outbreak began. You can see United Airlines down 72%. The volatility index is up nearly 400% since the outbreak came on. Obviously, oil's been under pressure and down nearly 60% since the outbreak happened. Obviously, you've got the Saudi-Russian influence in that as well. The COVID-19 virus obviously came out of China. It was in Hubei province. I think that the key takeaway for mine was looking back on what transpired in Hubei province was containment works, aggressive containment works. Now, I don't for a minute think or am that naive to think that the Western world can envisage containment as aggressive as they rolled out in Hubei province. I don't think that is a realistic expectation, but we need to do more than what we're doing at the moment. We need to start curtailing the spread of this disease, otherwise hospitals would become overrun, etc. So in Hubei province, the death rate was 4%. It was 1% outside of China. It's 2% on a global context. The reason Hubei was more was simply because the medical system couldn't cope with the rise of disease, the rise of infections in such a short amount of time. In Italy, the death rate is 8%. Obviously, some influence there in terms of the age of their population, but also the speed at which the virus took hold, the inaction from a policy standpoint from governments, and above all, the inability for their hospital system to cope with such an increase in cases. China is under control. I think if we step back and take a look at the stats, we can see that China is under control. But from a global perspective, which I'll show you just here, is the globally confirmed cases. It is rising exponentially. The rest of the world is rising exponentially. So, we're seeing huge growth in the cases in the US as testing steps up. The US has been pretty lax in terms of testing. They're now stepping that up. And we're seeing new cases outside of China are running at 3 times the rate of growth that Chinese had at its peak. In Australia, we've got about 1,300 cases. We've got about 7 confirmed dead. However, that case count is running at a greater than 20% per day clip. In terms of the market, I think it's pretty safe to say that this is a very uncertain time, both from the outbreak of the virus, where it all leads to from here, but whether or not central banks, governments, etc., can support economies as a result. Again, I want to draw back on Hubei province as sort of a roadmap on how to curtail it. So the feeling I get in terms of the virus itself is that we're about 6 weeks behind what they were in China. So if we use that premise, we should be starting to see a reduction in the daily growth rate of confirmed cases in the next 4 to 6 weeks. And that's what, from a market's point of view, the main thing that we need to be conscious of. So this chart needs to start plateauing in the next 4 to 6 weeks. I think it's safe to say that the next couple of weeks is going to have negative headlines coming out of the US as they ramp up testing. And that is going to be offset by some pretty aggressive central bank intervention from a policy response. So if I go to the chart on the screen there, that's the 10-year bond yield. And what that is showing is that bond markets, as well as equity markets, are pricing in a global recession. The data we're seeing out of China is supportive of that. China is likely to contract, which is something we haven't seen before. That in itself is enough to push the global economy into recession. Then we're going to have slowing economies in Europe, America, as well as Asia. So look, I think it's pretty safe to say the global economy is going into to recession. The equity and bond markets are already pricing that. The onus now switches to central banks and governments to provide a foundation to see whether it's to ensure that recession is a short-lived recession, not a prolonged depression. So central banks have cut interest rates pretty aggressively. If I think about where we were at the start of the GFC, we're sitting domestically in Australia with interest rates at 7.25. The first interest rate cut from the RBA was a whole percentage point. Right now, we're sitting in interest rates with 0.25. So that the ammunition in that chamber is very limited. That means that we're now charged with the fiscal side to support the economy from here. So governments need to step up in terms of the fiscal side. From Australia, we've had a $18 billion package launched. We've had second package that was announced today, which is $66 billion, obviously a lot bigger package. If we think about all of this combined, it equates to about 10% of GDP. So that's big. The market, though, prices off what's happening in the US, and the US are yet to launch a large-scale stimulus program on the fiscal side. Talk is that a $1.2 trillion package is near, and that probably is going to be a game changer in terms of markets. These fiscal measures could very well settle markets down. So what we're seeing is huge amounts of volatility hit the market, which undermines confidence in the market. The role of central banks, the role of governments is to ensure or shore up the confidence in the public markets. And that's what a large-scale fiscal response is likely to do over in America. Europe is running with their own measures as well. In terms of the equity markets, obviously they've been hit extremely hard over the last 5 weeks. The ASX 200 is down more than 30% over that period. This is a quarterly chart of the ASX 200, just to put into context how hard this has been hit relative to what we saw during the GFC. So the market traded 71.97 all the way down to 47.42. So it's more than a 2,000 point decline there, obviously, in the market. So it's aggressive selling. Stimulus is helping, and we need the added liquidity for markets, but we need a bigger fiscal response. We've got that today in Australia, and this week we're likely to get that out in the US. So look, I don't know whether that will be the precursor to turn markets around, but it should be supportive of markets from here. So we're looking for that to start calming markets in the near term. I think there's a couple of interesting points that we need to keep an eye on before thinking that the market is going to turn. Confirmed cases are still rising pretty rapidly. Italy is on the screen there. Italy is obviously important, but I think the cases or confirmed cases in the US is going to be the more important measure from a market's point of view. So I don't think the market will become bullish until, on a sustained basis, until we see the number of confirmed cases in the US plateau and start to decline. I think we're 4 to 6 weeks away from that at this point. So more volatility is expected in the markets. Now, in terms of our own portfolio, I would have liked to obviously have more cash going into this into this route. You can never have enough cash in the portfolio when the market drops 30-odd%. We didn't, and now we find ourselves with the market down 30%, and we're targeting an improvement in the quality of our positions rather than anything else. So we're looking to go up the quality spectrum. So in terms of the banks, we wrote about in the weekend report today that banks, that they're not all equal. Obviously, NAB has greater exposure to business banking, small business banking. CBA is more expensive, but it's got a better balance sheet. It's got better systems, etc. I tend to gravitate towards quality when markets become volatile like this, and CBA's the number one pick in the banking space, followed by Westpac. BHP is sort of the proxy to the resources trade. So if you think about resources that are exposed to global economic growth, if economic growth is slow, obviously commodity prices come under a little bit of pressure, but we're setting up for a rebound in global growth. When all of this passes, which it will, then we've got this huge amount of stimulus going into the economy. We've got a huge amount of pent-up demand, and that will underpin strong growth in the second half of 2020. BHP will be very well positioned to take advantage of that. And indeed, the whole resource sector in Australia, majority of resource companies in Australia are net cash, or the ones that have some debt, BHP, Rio, Fortescue have some debt. They have very easy ways to retire that debt. So they're under-geared resources companies coming into this downturn, which is a really positive thing. Something that didn't happen. That wasn't the case when we led into the GFC. Some of the more interesting growth companies have been hit. So Xero's been hit down from 90 down to 60. This is a really interesting business. We don't own it in the portfolio, but we're likely to buy it into weakness. They're an online accountancy or cloud-based accountancy software, a market darling for the last couple of years. They've got an annuity-style revenue stream. They're dominating Australia. They're dominating New Zealand. They're growing in the US. But it's that annuity-style revenue stream that is really appealing from an earnings point of view. So they're not all smoke and mirrors like some of the growth companies that are out there. So a high quality growth business is Xero, and that's one we're likely to put in the portfolio into further weakness. Lendlease is needs no introduction. It's going to benefit from increasing infrastructure spend, increasing fiscal measures coming out from the government, a reasonably sound balance sheet, and one of those companies that will make it through this current predicament. Sydney Airport's great asset. It's got such a competitive spot in the market. You can't replicate the asset that Sydney Airports has got, but debt's high. So it's got a market cap of 10 billion and it's carrying debt of around 10 billion. So that debt is going to, or potentially could become an issue for Sydney Airport. So, we need to, I think we're about 3 or 4 weeks away from looking at Sydney Airports as a potential buy. You need to look through to the other side of this virus and have some look through in terms of the earnings to be comfortable that they're going to be able to service their debt going forward. Service Stream is a stock that we've got in the portfolio that we like here. It's a network business, network access business, very much exposed in the telco space. What they do is not going to be impacted a lot by the coronavirus outbreak. They've got a sound balance sheet. They've come back from $3 to $1.83. And we like that business. So just as a quick sum up, I think the economic market outlook is uncertain. There's no two ways to sugarcoat that. At this stage, our base case is that this is a shorter term hit rather than a prolonged downturn. The massive tsunami of stimulus that's been hitting the market is going to be supportive of growth in the second half of 2020, and we're using this weakness ultimately to improve the quality of our portfolios, going up the quality spectrum, looking at a portfolio that we want to hold over the next 12 to 18 months or so. But I think it's important to also understand that businesses will go out the back door because of this. And businesses generally that go out the back door in times like this are those with considerable amounts of debt. So we're also being very vigilant, watching out for debt grenades, as I call them, and then remaining flexible and open-minded. This is a very fluid situation. But ultimately, we need to be seeing a reduced number of daily cases, and the US is going to be key in terms of that. So I hope you have a better trading week. It was a pretty tough one last week. Again, we'll look to improve the quality of our portfolios, the quality of the holdings in our portfolios as we continue to monitor this evolving situation. Bye for now.